BDCs largely outperformed during the period of Federal Reserve rate hikes starting in 2022. And this is really because, as the Fed hiked rates, the BDCs, which overwhelmingly invest in loans that have floating interest rates that are indexed to short-term interest rates, saw their interest rates rise on their investments. And yes, they do borrow some at floating rates, but they're overweight in terms of their balance between assets and liabilities. They're overweight benefiting from interest rates, rising short-term interest rates, that is. And so, therefore, they saw their net investment income increase. Many of them earned larger premiums to net asset value, but even more importantly, they were getting a lot more income, which led to higher dividends and special dividends. And so as a result of that increased cash flow, those hefty double-digit dividends, especially when you count the special dividends coming in, led to large total returns while their NAVs were remaining stable or even growing because they did retain some cash flow they could reinvest. The premiums enabled them to issue equity on an accretive basis and reinvest it, further growing NAV per share, thereby leading to attractive total returns, while at the same time you had REITs and utilities suffering from those higher interest rates because they're capital sensitive and their income is largely fixed in nature and doesn't benefit from rising interest rates. And in fact, the rising inflation largely caused them to have increased costs because they're more capital and operationally intensive, whereas BDCs are capital light. They don't really have any of their own operations other than some employees on their team. So again, inflation outsized hurt utilities and REITs, and by comparison, BDCs significantly outperformed. However, now the tables have turned. The Fed is pivoting to rate cuts. That sent REITs and utilities soaring. BDCs have lagged and even pulled back in many cases. And so in this video, I'm going to discuss which BDC I think is the best one to own in this current environment where the Fed is cutting interest rates. But before I get into the video, if you could please like this video, it would greatly help with its distribution and help me reach a wider audience and ultimately grow my channel. So thank you very much. Okay, so why do BDCs underperform? Okay, so obviously it's an unwinding of what I just said, right? The dynamic there that yes, as interest rates fall, their borrowing costs will decline some, but their net investment income will decline even more from their investments. And so that's a hit to their net investment income. And yes, there is another factor here to keep in mind, that's underlying credit quality or performance of the portfolio. But because the economy remained remarkably resilient in the face of these interest rate hikes, they didn't really see their non-accruals go up for BDCs. But now, so that means now as the rates come down, they're really not going to see a big tailwind to their underlying portfolio performance. So that's really not going to offset it. And so they're likely going to see their income come down. So with that in view, which BDCs are best to invest in right now? Well, I looked at the 10 Qs of the top 10 BDCs in the BIZD ETF. It's a prominent BDC ETF's portfolio, and to see which ones are most sensitive to net investment income on a net investment income basis to interest rates dropping. And so they all publish in there their interest rate sensitivities. The most sensitive were Golub Capital BDC, Morgan Stanley Direct Lending, and Blackstone Secured Lending. They all would see over 11% declines in net investment income on a 100 basis point decline on the federal funds rate. Now, obviously, there are other factors that may offset that, but that's, a good comparison of apples to apples between BDCs. So the lowest ones in terms of impact and net investment income are the likes of Main Street Capital, Sixth Street Lending, and Hercules Capital, and those all have mid-single digit declines of like 4 to 6%. And so you can see there's a pretty large spread there. And the thing is that, okay, you may think that Main Street, Hercules, and Sixth Street Lending, yes, they are great BDCs. It's great that they're not as exposed to declines in interest rates, but they all trade at large premiums between 20 and even over 70% premiums to their net asset value. And so that's a huge premium even to their own historic averages. And so I just don't think that that's worth it to pay that huge of a premium for that benefit. Even though they are good BDCs, I would wait, especially if they're still going to experience some headwinds, especially if we end up going into recession. And so I would wait until those valuations come down before buying them. Meanwhile, on the other end of the spectrum, you have GBDC, Golub Capital, I like a lot, but it's going to get hit. Morgan Stanley Direct Lending, another one I really like, but it's going to get hit. Blackstone is another great one. Blackstone Secured Lending, BXSL, but they trade at 10% premium. I don't think that's justified given how much their net investment income is going to get hit, and we could see an economic downturn. I think MSDL and GBDC are potentially worth making a case for buying, but again, they're not the best to buy if you're wanting to hedge against steep rate cuts, because the market is pricing in likely a couple hundred basis points of rate cuts yet here over the next year or so. And so which one strikes the best balance? So I think it's in the middle. You have ARS Capital Corporation, you have FSKKR, both that are towards the lower end, but still in the middle at about a 7.5% projected hit for 100 basis point decline in Federal Reserve rates to their NII. And so, that's not too bad, especially in that both of them are covering their base dividends by over 20%. They both have solid balance sheets, investment grade credit ratings, well-diversified business models. In fact, they're the two largest BDCs. And so, maybe these are the ones to look at. So where does Ares Capital Corporation come into play? Well, they still have a premium to NAV. It's not outsized by too much, but it is above the historic averages. Given, again, the headwinds for the sector, I'm not really in the mood to pay a premium to NAV for a BDC right now, especially relative to its historic average anyway. And so I'm not going to be buying ARCC. I don't think it's necessary to sell either. They have a great track record. But FSK, there's one that I like. Their underwriting performance has performed a lot. Their non-accruals are under 2% on a fair value basis. About 10%, a little bit less of the whole overall portfolio is now legacy. KKR is underwritten 90 or plus % of the portfolio now, and they're doing a much better job with their underwriting. Vast majority of their non-accrual issues are due to the legacy portfolio. They have a very big dividend. If you include the special dividends, it's close to 15%. But their base dividend, again, is covered by over 20%. And they trade at a very large, high teens discount to their net asset value. And so any headwinds from net investment income declines, potential non-accrual increases are more than priced into their discount to NAV. You're basically getting their troubled legacy portfolio for free, and you're still getting a nice discount on their remaining KKR underwritten loans. And so I think FSK, between its relatively low impact from Federal Reserve rate cuts to net investment income, its large exposure to senior secured and asset-backed lending products in its portfolio, its solid portfolio performance, its attractive dividend yield and coverage ratio, and strong balance sheet, as well as the strong underwriting performance of KKR and the increasing share of the portfolio that's taking, I think FSK is hands down the best BDC to buy right now, especially, again, in light of interest rate cuts. So there you have it. Hopefully this video added value to you. If it did, please make sure you give it a like, subscribe to my channel so you can help me grow my channel and get all my future content. And let me know in the comment section below which BDCs you like and which ones you don't like right now. Thank you very much. See you next time.